background, I was a professional investor in the hedge fund world for over 20 years. I'm also the co-founder and chairman of Hue and Hue Chocolate. I've been an angel investor in probably over 20 companies over the last decade. And I'm still an investor in a handful of companies and still very involved in Hue as the chairman. And so I've been seeing a fair amount of activity that's going on right now. And I thought it might be helpful to provide some views as to what I'm seeing currently, but Kirsten also thought it'd be helpful for me to provide some views as to what I witnessed in 08 and 09 as an investor and what I witnessed in 99, really 2000, 2001, 2002, in terms of things to just pay attention to as entrepreneurs. And many of you are probably younger than me and didn't live through 2000, 2001, 2002, at least didn't live through it as a business. And so I thought it'd be helpful to go in kind of that order. In terms of what I'm seeing, fortunately for most people on this call, food is still deemed an essential business. So in most areas or most aspects where places are being shut down, work is being shut down, people are being furloughed, food seems to be exempt from this. Grocery stores pretty much everywhere, including the strictest countries in the world, are remaining open. I think the real issue right now is the related businesses that are part of what's helping food and entrepreneurs within food. Specifically co-mans, logistics, supply chain, and 3PL operators. And what we've already started to see is that the labor has become challenged in a lot of those areas. If you have a direct-to-consumer or e-com business that has any presence, most likely your business is up considerably. The e-com business for Hue, depending on channel, is up anywhere from 100 to 400%. Our Amazon business is up 400% over the last month. So that's obviously a positive. The negatives are, people shopping in stores. There seems to be a lot of hoarding, which has been good, but restocking has become a challenge. And recently Amazon's had a challenge in restocking, partially because they're just being overwhelmed with demand for more essential things, and partially because there's labor shortages. Grocers are trying to pay everyone overtime. They're obviously trying to focus on things that are more essential versus things that are more discretionary. We've seen a number of issues with the grocers, particularly with out of stocks. There's also an issue with a lot of the distributors that go to grocers like UNFI and KeHE, where they are prioritizing essentials so that they can get things like disinfectants and cleaners and tissues and toilet paper and paper towels onto their trucks. And they probably don't need, high-end organic food items. And so there's definitely going to be a lot of out-of-stock issues for some of you, and I'm sure you're seeing that now. What's fascinating is that what's essential is dependent on the region. So different regions and different cities and the buyers for those regions have different elements that they're deeming essential, which I find to be fascinating. And so you're going to be seeing, a lot of what seems like random activity with regards to that. And then for a lot of you, which are smaller, younger companies, resets are a big deal. And it appears that resets are postponed or canceled for a lot of grocers. I'm of the belief that even if they're saying they're canceled, it's not going to be the case. But I think as entrepreneurs, you have to operate as if that's the case. The reason for that is really labor. When products are reset in grocery stores, there's a lot of work and labor required to, put new products into the system, put new products onto the shelves, stock new products, take existing products off the shelves. And so, everyone is kind of struggling right now. And I think resets are going to be the biggest challenge for a lot of smaller companies right now. In terms of, the conclusion is, e-com's up a lot. People are obviously buying. I'm quite optimistic about consumables as a category, particularly food, because people still have to eat more than anything else. The question is, as entrepreneurs, how do you get it to them? And how do you make sure your consumers or your potential customers are able to get the food that they need? And then there's definitely going to be some second and third order effects on the grocers, which even if your volumes are up, getting it stocked appropriately, avoiding out of stocks it should continue to be a problem. And if this continues to accelerate towards the negative in terms of it's spreading, I would anticipate we haven't, on the Hue side, we haven't had any issues with our co-man who makes our chocolate. But I would imagine at some point in the next few weeks, you're going to have more and more co-mans that have to either do reduced hours or shut down because of the concerns that they have. So that's something, make sure you have a good relationship with your co-mans and you're regularly checking in on what their issues are and their concerns are. In terms of historical context, I think it's really important for all of you to recognize that this is really bad. And we don't have much precedent for what's going on in terms of the economy. Today, they just passed a $2 trillion bill, which is the most stimulus I've ever seen in my lifetime. This is basically double what they did in the beginning of 2009. And instead of taking months to enact it, they did it in 2 weeks. This is not stimulus. This is like a nuclear bomb in the positive way of what they just did to try to support the economy. But as it relates to entrepreneurs, the thing that's important to remember is in 01, 02, and in 09, liquidity and funding dried up literally overnight. And there were a lot of entrepreneurs who thought, they'd done their A, their B, their C. They felt like they were on top of the world. And then literally in a matter of weeks, there was no bids for their business, nothing. And everyone tightens up and everyone freaks out. And this is normal human behavior. But what I think all of you need to remember is that survival is the single most important thing you can do. Get it out of your head in terms of, what you thought your valuation was 2 months ago. If you can't survive, it doesn't matter what percentage of the pie you own, it's irrelevant. And you have to make sure that you are seriously contingency planning on survival, because the people who come out of this with their even a fraction of their business intact are the ones that win later. And if you look at 01 as an example, Apple was basically on the verge of bankruptcy when they launched their iPod, which was literally a month after September 11th. Most of you don't realize that Apple was on the verge of bankruptcy back then, but it was. And they took a risky bet in launching the iPod when they did. And Amazon, from peak to trough, dropped over 95% into 01. And a lot of people thought Amazon was going to go away. And both of those companies figured out ways to survive, and they're now the two largest companies in the world. 08, 09 was similar. There were lots of darlings that quickly evaporated. And even before the coronavirus, we saw a bunch of darlings like Brandless, WeWork, Casper, all suffer significant problems because they were playing this game of just trying to grow revenue at any price, not care about the business model, hoping that investors would just care about revenue growth. And I think what has happened, and I've been saying this for a while now, but this has certainly accelerated it. What's happened is investors are now realizing, again, and this happens pretty much every 10 years, that companies ultimately need to make money. And I'm not saying that any of you on this call need to be making money right now, but you need to be able to have a path to making money, and you need to be able to have a path to surviving, 6 months of no funding. Um, and if you're not, then you have to think really hard about how much dilution you're willing to take and how low of a valuation you're willing to accept, whether it's borrowing or issuing equity. Survival is the number one goal for all of you. And if you can get through this, there will be a lot of wreckage that will not survive this. And the analogy I've given to some of my friends and investors in some of my businesses is the shrimping boat from Forrest Gump. I think it's the perfect analogy for now. And if you remember that scene, they weren't able to catch any shrimp for the first, month or two that they were out there. And then that hurricane hit and it wiped out every single boat except for theirs. And then they were the only one left standing, and they had just a boatload of business thereafter. And so I'll leave you with that, and I'll stop there, that I think the single most important thing to remember is it's going to be much harder for the next few months. Capital will be much harder to come by. Investors are going to be very scared right now. You're going to see a lot of bankruptcies, a lot of quick overnight failures like you saw with Brandless. And that your goal as an entrepreneur is to be scrappy, and not to have an ego, and just figure out how you get through this, because business will return, and humans always figure out a way to get through this type of stuff. And all you need to do is make sure you're there for when it returns.
Thank you so much, Jason. Clayton, any words of wisdom on how companies can get through this and survive?
Yeah, that was great advice from Jason. Had me taking notes. But, this is, as Jason said, an incredibly unique event, black swan, if you will. Luckily, we're in the industry that we're in. Food and beverage will get hit less than certainly a lot of other industries out there. Strangely enough, certain companies will actually benefit from this. We're seeing it more from the established brands being the ones that benefit. I would say Jason mentioned it. Matt, after me, will certainly get into it in more detail. But, I think that any revenue in your forecast coming from, from new product launches, coming from new retailers, there's risk there. So I'd certainly build that in. But there will be a continued uptick, I believe. And, just in Q2, you're going to see 60 to 100 billion in food sales shift from restaurants to grocery stores. So, depending on what category you're in, that's anywhere from a 35% to 100% increase in grocery store sales that they're going to be seeing in various categories. Out of stocks are going to be a huge issue. I'm already hearing that Whole Foods is going to start using U.S. foods for some of their higher volume items. We've got real concerns over that. There's been zero communication from U.S. Foods, yet they're, working on shifting a lot of their SKUs over to U.S. Foods. So there's, we're learning more there as it unfolds. But UNFI obviously is really struggling to keep up, given the number of SKUs they have. Where customer acquisition cost is going down for companies. Obviously, y'all probably seen it, but there's going to be, trade spend and promotional spending is being cut significantly. So, with most of our companies, we're anticipating that they're going to see significantly better kind of lower trade spending for the year than what's currently anticipated. This is proactive. Most of the retailers are being proactive here and just cutting, promotions. But we're also encouraging our companies to cut promotions. When there's supply issues and you're just worried about out of stocks, there's no reason to put stuff on discount. So at least kind of for April, May, we're seeing most of those promotions being cut and going away. Communication, I think, is going to be so important right now. We all feel it on the call. We were having a dinner conversation a couple of nights ago with my family, and it was, we were just talking about kind of the general level of anxiety that people are feeling due to this. Especially you have to work from home, so there's less human interaction. The phone's kind of glued to my ear all day, like a lot of other people. So I think communication with your employees, to ensure their safety and doing everything that you can is paramount. I put that as kind of number one priority, is kind of your people safety. And then trying to put them at ease. We're going to see massive upticks in unemployment. A lot of people are estimating as high as 20% here over the next couple of months. So, employees, families, they're very worried about this stuff. So anything you can do to communicate consistently and often with them, to put their mind at ease, talk about safety, make sure you're taking steps there, is really important. We're seeing a lot of safety measures put in co-packers and companies that are manufacturing themselves, taking additional precautions. We're seeing even small companies that only had one shift move to 2 shifts, and making sure that those employees in those different shifts don't overlap. We're seeing some even move to 3 shifts, and just taking extra precautions of wiping down equipment, tools, kind of in between shift changes, and making sure that there's no overlap, so that if there was an outbreak with one of the employees on a shift and they needed to shut that shift down, you still have another shift or 2, available for production. So we're seeing those precautionary measures. Evaluate your supply chain, obviously kind of tier 1 and tier 2 suppliers being most critical. We're seeing increased in inventory, both finished goods and raw materials right now. If you feel like there's risk there, you got to balance that obviously with liquidity, which is so critical right now, as Jason mentioned. I will say with a lot of these, we're having a tough time getting a hold of raw materials with some companies, but I can tell you just from the, don't ever underappreciate the human aspect of this. The squeaky wheel will often get the grease. So talking to those suppliers, just doing everything you can to secure the production time you need, the raw materials that you need, and over communicating with them, and then thanking them, when they do come through for you, because people, I think right now are feeling underappreciated in a big way. So I would, with your suppliers, I would make sure that you know that they're appreciated. Cash is huge. We're seeing a lot of companies, even profitable companies in our portfolio, even companies that are benefiting from this COVID and this increase in grocery stores, are taking cost-cutting measures, being very active on trade spend. We're seeing salary reductions, from 20 to 30%, oftentimes that scale depending on, and with floors usually in place, like if it's hourly workers or if they're making under a certain amount. But seeing a number of companies be very active in whether it's furloughs or trimming salaries proactively, at least for a few months here, to make sure that there's plenty of liquidity. We're also encouraging companies to draw down their lines of credit if they have lines of credit, because there is questions and concerns over the banks, freezing those. That's usually a pretty cheap cost of capital if it's with a bank. So I'd rather have too much cash right now than not enough. Demos are being shut down. I think that's gonna last for at least 2 to 3 months. So we're seeing significant cuts on marketing spending. But preserving that cash and just making sure that you've got, I would encourage all of you, as you look at this, to come up with some various kind of new forecasts, especially around your cash flow forecast, is to look at, what if our sales are 30% less than we think they're going to be this year? What if they're 40? What if they're 50? Your business better than anyone, but any area that you think there's risk, especially new product launches, I would flag that as really high risk to evaluate in terms of kind of running analysis on those cash flow models. I would really look at any new product, any new doors coming online within grocery. I deem that as pretty high risk. It's probably at least going to be pushed back. Matt will probably have a little bit better visibility there when he comes on, but and then see where's my cash at the end of the year, because right now survival is the most important thing. You just want to make sure you get out of this on the other side. This also, depending on what your staff looks like, it's definitely a time to look at A players versus B players, nice to have versus need to have. I'd much rather take salary cuts than let people go. But this can also be a good umbrella to stand under, you know, if you do have to make some cuts to some less critical employees to make sure that you kind of weather the storm. Because I think it's going to be very challenging to raise capital, you know, here over the next, you know, especially 6, but even up to 12 months. So doing everything you can to ensure that you've got enough cash to get through the end of the year with no new cash coming in will be critical. But as Jason said, we'll survive this. We've been through worse, and we'll get through this. We're in a better industry than most. I found that I'm feeling incredibly grateful in a strange way through this. We still have, hopefully we all on this call have our health and our families, and let's just keep our businesses intact and get through this on the other side. But you guys have a lot of resources to draw upon here, and you know, SKU, the mentors at SKU will continue to make ourselves available to help everybody navigate through this.
Thank you so much, Clayton. I'm going to just turn this right on over to Matt at Kettle and Fire. What are you doing? We had a quick conversation and you gave me some really good tactical things that you're looking at, and I think it'd be lovely to share to this group.
Okay, fantastic. Thanks for the intro. Can you all hear me?
Loud and clear.
Perfect. Thank you so much. Some really good insights, Jason and Clayton. Thanks. I was taking notes as well. Just a little background. First of all, I appreciate the opportunity to speak with you all today, as we're all in this together as an industry. I've been a part of brands under 100 million all the way up to billion-dollar companies like B&G Foods, post-acquisition of Pirates Foodie, and Hershey, post-acquisition of Barkfin. And my passion is working with the entrepreneur, building emerging brands in health and wellness. So I'm really happy to help each of you, especially in uncertain times. So the 3 questions that Kirsten asked me to kind of address today are, what are you doing to cut costs? Where is your attention focused? And, how are you looking at your 2020 forecasts? I know we're a little bit over schedule now, so I'm going to try to plow through some of the things I wanted to share with you all today, but certainly available for Q&A afterwards or even after the call. But in terms of what are we doing to cut costs, first of all, about 2.5 weeks ago, we started proactively reaching out to our retail partners to throttle back promotional activity. This was all done really in an effort to normalize huge spikes in sales and to maintain healthier in-stock levels. Clayton mentioned some of this a little earlier as he was speaking as well. What we've seen over the past 10 days or so, though, is retailers have been significantly dialing back or canceling promotions, especially in the hardest hit categories. We've seen this action from Whole Foods, Kroger, Publix, and the list gets longer and longer each day. It's really important for brands to understand which promotions ran and which ones didn't, so you don't get billed for those promotions that didn't execute. Another thing too, if you have off-invoice promotions with some of your distributors, it's really important to have conversations with your supplier relationship managers to make sure that you are doing everything you can to restrict overbuying during those off-invoice periods, because that just ties up unnecessary cash. We cut back on shopper marketing initiatives too. Like we had a couple campaigns going with Ibotta and Instacart. We turned those off. We did more recently, though, reactivate Instacart so that we could get our fair share of the online shoppers that are moving more towards that platform. But we've left Ibotta shut off for the time being, so we're not spending cash unnecessarily there too. Another thing that we're doing to cut costs is we're evaluating our discretionary OpEx for the balance of the year. We're looking at every account and every vendor and reducing spend in areas like trade shows, which likely will be canceled anyway. That includes industry-wide trade shows as well as some of the UNFI and KHE tabletop type shows. We're canceling or reducing coupons and IRCs, really cutting back on the nice-to-have items and categorizing them into low, medium, and high impact on company of cut, and seeing what can be paused or cut back now that we could turn back on at a later date as things kind of get back to normalcy at some point in the future. We've also cut back or paused some new hires that we had planned for this year as well, as a way to save some cash. I know Clayton touched base on that as well, in terms of just looking at the overall team and what positions are necessary and ones that may not be at this time. We don't have a robust field marketing activity plan during this time, but my recommendation would be, if you do, that you should cancel or significantly reduce field marketing activities over the next 60 to 90 days as well. From a D2C side, we're spending less on acquiring new customers right now. We anticipate customer retention rates will be much lower with those one-time pantry loaders that we're seeing flocking to our website now. So it's really important to be mindful of new customer repeat rates falling and the cost to acquire those customers. So those are some of the things that we're doing to cut costs. The next question I wanted to address was, where is our attention focus? And Jason and Clayton addressed some of these things as well. One of the things that we're doing is we're assessing risks in the supply chain from ingredient sourcing all the way to manufacturing. We're seeking alternative ingredient sources, manufacturing redundancy, and fulfillment alternatives, and evaluating, what's kind of high, medium, and low risk within the supply chain. We've got major retailers that are seeking alternatives. Clayton mentioned Whole Foods and U.S. Food Service. The traditional distributors in our industry have not been able to keep up with demand, and frankly, I don't think have a really good pulse on what the demand is. They've been throttling back orders to stores, limiting piece counts, and we're seeing a lot of challenges there too. So we're looking for alternative routes to market. We've had PCC, Whole Foods, Publix, some major accounts asking us how we can get them product direct. Keeping customers in stock is another thing that we're really focused on right now. Balancing and strategically prioritizing available inventory across retail to keep shelves full, direct-to-consumer and Amazon to keep up with unprecedented online sales. So if you don't have an online platform today, I would challenge you to get online and also make sure you're on Instacart and taking advantage of the shift that we're seeing in consumer behavior over to online grocery and direct-to-consumer. Another platform is a lot of retailers have their own online grocery pickup platforms. Those are some of the things that I would recommend looking at as well. Clayton mentioned communication. I'm mentioning that as well. Bad news should travel faster than good news. We as an industry and as manufacturers in this industry have a hall pass right now to some degree, but over communicating is essential. If you're shorting orders, delaying deliveries, if there's changes to ordering parameters based on the current climate, all those things should be communicated with distributor and retail partners sooner than later. Another thing that we're focusing on is helping solve retailer challenges. How can you help your retail partners fill holes on shelves? What opportunities exist to level up your partnership with retailers in this time when they're, just reeling with unprecedented demand and making a lot of changes in how they're operating as well. Another thing that we're focusing on is what does forecast look like over the next 8 to 12 weeks? Because it's, for us, we're in a category where we're seeing unprecedented sales, record sales, and, it'd be easy to say, let's just ramp up production and make everything we possibly can make. But we have to be careful too, because we're not cash rich and we need to really balance inventory and the real opportunity with cash. I would also suggest doubling down on core items. We've deemed our top 3 or 4 items as never out internally. Back in 2008 and 2009, retailers stopped focusing on items and rather double down on, or stopped focusing on new items and rather double down on core items and the strongest brands. So I would challenge each of you to think about that and how you can position your brands and items to be in that mix. So start prepping your case on why your brand should be one of those brands. Look at things like dollar sales per point of distribution if you have low ACVs. Look at trends, how you're differentiated from other things that are on the shelf. Maybe even a focus on health and wellness and immunity boosting products have an advantage here as well. So really focus on, the assortment, new innovation launches, cash, and balancing all those things out. I think Jason mentioned it about resets being delayed or canceled this year. We're starting to see a little bit of that now. We're planning ahead for that. It's also working with distributor partners to get your share of their attention. The major distributors in our industry do not have a grasp on the demand and are having a difficult time servicing our retail partners right now. So we have daily conversations with our supplier relationship managers, our replenishment managers, our supply chain partners to ensure that they are aware of what the situation is on shelf. And I think we've got actually a much better grasp on what the actual demand is versus what the distributors do at this point. So I think it's just collaborating with them, giving them all the information that you all have to make sure that we keep product running through the supply chain. And then lastly, what are we doing for 2020 forecast? And I think we all need to take a clean sheet of paper out and rethink the whole year. These are uncharted waters and there's still a lot of unknown. As Clayton mentioned, I think it's important to lay out 3 or 4 scenarios, anywhere from exceeding original plan to potential doom and gloom scenarios where you fall short of plan and what impact each of those scenarios has on your cash position. Will you be in a good position or will you need to raise and when? I kind of view this as like, I live in Florida, so we have hurricanes here during hurricane season, and there's always, 20 different models of the direction and the path that the hurricane can take. And so I kind of view these various scenarios here for forecasting for the balance of the year from a sales and cash standpoint, and seeing which scenario is the hurricane going off in the Atlantic and not having any catastrophic impact, all the way down to the scenario where hurricane hits a major city and there's big, large impact. So just understanding what those various scenarios are for your business and how that impacts your plan and your cash position as you go throughout the year. And then, focusing on the next 8 to 12 weeks, balancing that cash and inventory. We're experiencing record sales across all channels. We're being very cautious on building inventory so we don't put ourselves in an upside down cash position. In some cases, we're prioritizing D2C, so we get paid immediately versus retail where we may not get paid for 30 to 60 days. And traffic has also diminished in some of the hardest hit areas like Washington, California, New York. We're already seeing sales there trending about 20% below other areas that aren't as heavily hit at this time. So that's a wrap on what I have to share, given the time constraints here and trying to get back on track. Hopefully that's helpful to you all, and I'm happy to help any way I can.
Matt, thank you so much for those really practical, tactical tips. Love for you to interject as we go through this next portion that is going to be focused on capital and really the finances to weather this storm. So we have Felipe Vega from Go IronClad, Justin VanAntwerp from Propeller, and then Stephen Borrego from Texas Capital Bank, all on the line to give various perspectives on what the capital market and looks like, where there are sources of funding available for the companies that need it, practical tips on getting through an SBA loan or lines of credits from a bank. And then Justin's going to wrap it up with some finance and accounting, cost-cutting measures and ways that you can protect your cash flow during this time. So with that, Felipe, I'm going to kick it on over to you. And thank you so much for being a part of this.
Yeah, thank you so much for having me here. So yeah, I'm with the IronClad Consulting Services. We're a full staff financial accounting and operational advisory service business. We serve clients across a broad range of industries throughout their various stages of business lifecycle. About 75% of our clients are in the food and beverage alcohol industry. So we've seen, like everyone's mentioned here, a lot of uptake, a lot of big growth. But with that also comes, how are we going to pay to keep up with demand? What we've noticed too is sometimes extremely fast growth is as bad as no growth at all from a cash flow perspective. We have a few clients that are using some asset-based lending mechanisms. Others are relying on the Amazon lending platforms, Cabbage, Fundbox. Others between also using CircleUp. All these have a pretty high interest rate compared to, other companies that are taking investor loans or purely drawing down, like Clayton mentioned, drawing down other bank lines of credit to ensure that they have the money readily available. One of the biggest, I think things that we're looking is the companies that are growing tremendously online is how do you cover that, right? Because normally an asset-based lending will not lend with companies that are 100% e-commerce. So we're looking at different factoring mechanisms to be able to borrow upon getting inventory lines of credits and, using other companies like, lines of credit through Clearbank or other forms of mechanisms. That way that we can easily get the money upfront to cover our inventory cost. The majority of them, like everyone's mentioned before, are taking some cutting measures, 20 to 30% payroll cuts. They're freezing their hiring, cutting R&D, and just seeing what they currently have to be able to keep up. The one thing that I'm waiting to kind of see here is looking at companies like CircleUp, and because they have different forms of funding mechanisms, and looking at what's going to happen with their algorithm, how that's going to function with a lot of our CPG companies that have had tremendous growth online. It'll be pretty interesting to kind of see how well their algorithm really works in this scenarios that we're about to get into.
All right. Thank you so much, Felipe. So, Stephen, I'm going to turn this over to you. I've had quite a few SKU companies asking questions and navigating the process of SBA loans. Can you just describe, what that process looks like, and then just the overarching underwriting that happens from a bank?
Sure, and thanks everybody for having me. It's nice to be able to see people's faces, and being in banking, we thrive on kind of face-to-face interaction and having coffee with folks, and so this is nice to actually get to see people's faces and hear voices. And so it's very odd for us too, because we're used to being inside of an office and sitting on a chair and seeing our coworkers, and so it's been kind of tough for us. But we're adapting. We're all doing Zoom and other conference call methods. But to answer your question really quick, I'm just gonna give you a high level of really quick. Texas Capital Bank is a $34 billion commercial bank based out of Dallas. We have offices in Dallas, Houston, San Antonio, Austin, and Fort Worth. And we have customers, in an array of industries. And so right now, the ones that we're really helping out a lot, obviously, are restaurant, hospitality, and nonprofit. And so, we're definitely in this together. And so that's what we've been spending a lot of our time with, is helping those clients in those industries. But as far as what folks can do to access capital, what we're communicating to folks is that it's still too early to figure out the stimulus deal. But what we are doing is we are directing folks to the SBA site, the folks that are interested in disaster relief funds. And from what we've heard, it's up to $2 million in disaster relief that you can use in numerous ways. I believe the term on the loans up to 30 years, but however, it depends on ability to repay. I've seen rates 3.75%, and then 2.75 for nonprofit. Other things that I can talk about though is, as far as processes and timelines, they're going to be a lot longer now. So if you were having trouble before, expect a little bit longer wait times now. Obviously, what we're really digging into is what a lot of the guys have already been talking about is projections. And I know it's super difficult sometimes, especially for a restaurant, because if a restaurant's closing, then they're like, hey, I've got zero income. So what do you want me to project, right? So it's a little bit different, and you guys are in a fortunate industry to where, yes, grocers are overwhelmed and food is essential. And so I would just say, processes, timelines are longer. Expect more questions from your banker. Be able to project to the best of your ability, best cases, worst cases, something in between. Be able to really be thoughtful about, if top line is soft, how are you going to cut costs? As previously mentioned, what are you going to do with headcount? What are you going to do with marketing? Are you going to change your strategy? Moving on to, lines of credit. I think the guys have already kind of touched on that too, is if you have access to one, request a draw as soon as possible. What's going to be really difficult though is to go into a bank now and say, hey, can I get a new line of credit if you don't already have one in place? And so because of the underwriting factor, it's going to be kind of combing through every little single thing that you can think of to get approved. But I would just say, be honest with yourselves, be honest with the banker, over communicate with the banker, be transparent. We want to know what the money's going to be used for. That's very, very important. As far as additional liquidity goes, that's really important though. If, it's kind of a different message when you say, hey, I want to access the line to just hang on to it. It's more meaningful to us to say, hey, how are you going to use it if you do use it? Because we're in a very much in it together attitude of how are we going to share this risk? You know what I mean? We don't want to just fund it and then it goes out the door and then it's spent in a very kind of irresponsible way. So as far as any kind of specifics, though, I'm happy to direct folks to more SBA disaster relief information, and happy to chat with anybody really on a separate direct message, whether it's LinkedIn or Zoom. So just let me know how I can help as well, and really thank you guys for the few minutes of time. Thank you.
Thank you so much for those thoughts, Stephen. Justin, I'd love to hear your thoughts on some accounting measures that these companies need to be aware of to protect their cash flow situation. And any other thoughts you want to add to this general conversation?
Yeah, sure. Thanks, Kristen. Appreciate that. And thank y'all for having me. As Kristen mentioned, I'm with Propeller Industries, and similar to Felipe and IronClad, we provide full service finance and accounting for early stage venture-backed companies with a heavy focus in the CPG area. I think we've got a little over 100 active CPG clients, so we've got some good pattern recognition here in this space. I guess the disadvantage of going last here is I don't have a lot to say that hasn't already been said, but I think this will serve as a nice sort of end cap and summarization of some of the things that the guys have talked about already. On our side, we're taking the approach that yes, I think we're still very early in the process here, but definitely encouraging and working with all of our clients to reforecast on multiple scenarios. So that, and doing that sooner than later, so that you're not trying to do it midstream as things are going sideways, so that you have a plan and you know in advance what levers you can pull to mitigate or adjust for things that you're able to anticipate happening. And I want to also stress, I think Jason mentioned it first, but supply chain is very important. And so even if you are seeing an increase in orders or not just staying flat, you want to just protect that supply chain as much as possible. Redundancy is going to be key. And even if like your co-man's not shutting down, we're seeing cases where our clients are struggling to get line time because they're getting pushed out for bigger companies or products that might be considered more essential than theirs. So there's definitely some risk we're seeing there. As far as specific measures you can take on cutting expenses, I think most of this has been mentioned already, but the key is to get to profitability if at all possible, and if not, do everything that you can to reduce your burn. And we're advising companies to plan as if they won't be able to raise, again, as Jason mentioned, for 6 to 12 months even. So the first place to start there is just kind of start with a blanket hiring freeze. And as I'm going through these, like I realize that there are going to be exceptions to these situations, but just kind of, I think these are generally applicable to most companies. So start with a hiring freeze. Holding off on product launches, I think, has also been mentioned already. Those tend to be expensive to just get off the ground. They're kind of distract from everything else that's going on, and they're often too dilutive to margins. So that's going to reduce your profitability even further. The marketing bucket is a big area where I think there's probably potential for most companies to significantly reduce the total spend. But again, we want to be strategic there. And if you've got the inventory and supply chain to manage it, consider increasing budget in channels where you're seeing increased ROI. Again, this is all kind of situational, and you'll want to kind of be strategic about how you're doing that. And then some of the other kind of easy buckets to cut on the operating expenses, of course, travel is pretty much going to zero. Field marketing is gone, and trade and table shows are also right out. And then the last thing I've got here, which nobody wants to do or talk about, but is reevaluating the current staffing. There are, like, everything should be on the table, including reduction in force, reduction in salaries. We've got clients starting with cutting bonus packages and benefits as a way to kind of avoid any layoffs if they can. So consider those too. The other thing I want to touch on a little bit more is on the working capital side. And if you guys were in the class we had on Tuesday, you heard me harping on this a little bit. But there are both internal and external actions you can take on the working capital side. Felipe talked about line of credit a little bit. We're advising all of our clients to go ahead and draw as much as possible on the line of credit if that's available to you. Reach out to your vendors and suppliers and ask for extended terms. You may have to compromise or kind of balance between asking for extended terms or asking for preferential treatment on just getting products or getting production. But it doesn't hurt to ask them for extended terms. We advise that in normal times. Like that's just free debt and non-dilutive capital in the business. Another one, I'm sure the investors on the call are going to love to hear this, but we're also having our clients reach out to their current investors, and communication has been mentioned several times in this call. And I think that's really important. But talk to your current investors. They already have vested interest in seeing you succeed. So they've got, in many cases, the most to lose if you fail. So they'll be more willing to help you figure out creative solutions to get to the other side of this thing. So talk to your investors and your board about how to continue to fund the business. If you're in a situation where you're trying to raise equity, we're talking to clients about considering convertible notes as opposed to a price round right now. Those are generally faster to execute and it's just easier to get set up. So if you're in a situation where you need that capital in the door as soon as possible, that can be a different option for you. And then, as Stephen was just mentioning, keeping a close watch on all these different stimulus options, including SBA and CARES and even state measures. I don't think I've seen anything specific for Texas yet, but keeping an eye on all those things. There's still not a lot of clarity on exactly who qualifies for those things. And in some cases, you have to show negative impact to your business in the last couple of weeks. So if we're seeing uptick in sales, that might not be an option, but pay careful attention to that. We're having clients go ahead and submit applications as those processes come online. So again, so they can get in line and just kind of get in the process, so they don't have to wait around for 6 or 8 weeks once those funds start flowing. So those are all external measures you can take on the working capital side. And then a couple of internal things is just kind of ramp up your collection calls on past due accounts. We haven't seen any slowdown in payments coming in from the bigger distributors like Unify and KHE just yet. But that could happen, right? We don't know. So just kind of stay on top of those past due accounts. As soon as they go past due, just get on the phone. And as Clayton was saying earlier, the squeaky wheel often gets the grease. So if you're in your customers' ears saying you need payment, they're probably going to be more likely to pay you first. And then the last thing here, again, I think it is a good just sort of cap on the discussion, is just managing your inventory carefully. It's going to be a fine line to walk, especially without supply chain redundancy. So keep close eye on that. Carrying less inventory in the near term is going to increase your cash, but you need to balance that with availability and margin.
Justin, those were amazingly specific things that all these companies can put into action right away. So thank you so much for all of that. I am going to wrap up with some additional comments, but encourage everyone to go in the Zoom chat feature and ask whatever questions you may have from these panelists. I think between Matt and Felipe and Stephen and Justin, we really kind of drove the message home what customers or what companies should be doing directly. But I do think I want to go around that group again and ask, them to share specifically negotiable terms to various contracts that they should be asking for to help them kind of weather this storm. Matt, is there anything from a distributor perspective or a buyer perspective that are asks that these companies can put forth?
Yeah, I think, the focus there should be around, if you're contractually obligated to have certain fill rates, you want to know what those are and make sure that you won't be fined for not being able to meet fill rates. I think if you have off-invoice programs in place, that you need to try to do your best to work with your partners, with your distributor partners to mitigate overbuying during those off-invoice periods, if not, cancel them altogether. I think it's important to understand, from a promotional perspective, which promotions make sense to run and which promotions make sense to cancel. And, as I mentioned earlier on the call, to ensure that you're aware of which promotions did run and which ones didn't, so that you don't get billed for those promotions that already ran. Does that help answer the question?
Absolutely, thank you. Anybody else want to weigh in on that question? Well, we have a question coming in from the audience. So most of the power has shifted to large format. So how can small food and beverage providers win in their business during this time? Matt or Felipe or Justin, do you want to give any thoughts or guidance there?
Sorry, Kirsten, can you repeat the question one more time?
Oh, absolutely. If it's been mentioned a couple of times that the power has shifted to large format companies and manufacturers, how can small food and beverage providers win in their business at this time?
I think just keeping supply available and on hand to be able to ship is going to be helpful. I was in another one of these things the other day, or maybe that was last week, and somebody brought up a point that I thought was really interesting as far as kind of reallocating marketing spend in the online channels. But especially in Amazon, you can place specific ads on larger competitor pages and be ready for when they go out of stock, your ad is right there and ready to go, and you've got supply ready to ship. So you can essentially steal their sales.
Yeah, that's a really good point. I know here at Kettle and Fire, because a lot of the major CPG companies that play in our space, soup and broth, are out of stock. As of last Thursday, we had 100% share of voice on Amazon for the soup and broth category. As they've come back online, we're still sitting about 85% share of voice, but that's with little to no ad spend. So just being aware of your competitors' out of stock situations too, and kind of modifying, increasing or reducing your ad spend online too, to attract, to get your share of voice and to acquire new customers.
Thank you guys for that insights. With so much emphasis going online, what words of advice do you have, Matt, for just really winning on Amazon? Do you have, and you don't need to necessarily disclose this, but I don't know if a large portion of your sales do come from Amazon. And I know that can be a big bear to tackle for smaller brands. So any advice there would be great.
Yeah, I think it comes down to making sure that we're allocating inventory appropriately across all channels, including Amazon, communicating with your key contacts at Amazon in terms of what items you have in stock, what items are out of stock, when those out of stock items will come back online and be available to reactivate on the website. and just rethinking ad spend and the cost of acquiring new customers on that platform. It may not be necessary to spend at the rates you would normally spend, just based on the trends that we're seeing on Amazon and the cost to acquire those customers.
Great. So here's a question coming in from Michael Aaron about hiring. We discussed, evaluating staff. If a business is actually benefiting from this crisis, would they still recommend not hiring for critical roles? Maybe not necessarily looking at cutting the staff internally, but just placing or hiring that CMO. How would you advise companies when making strategic hires and staffing choices?
I can speak to this, Kirsten. This is Jason. I think it depends on your budget. It depends on how much cash you have. I think someone on this call had mentioned you definitely have to really stress test your budget for this year in terms of assuming worst case scenarios. Assume you don't get any of your new products into retailers. Assume there's no resets. These are worst case scenarios, but you have to model them. And I think, ironically or counterintuitively, hiring A+ players now, if your budget can support it, is probably the most important thing you can do, because A+ players are able to navigate this type of uncertainty much better than C or D players who are cheaper. So I think if you're in a position where you can weather the storm, I definitely would lean into making a few great hires if you have them. And conversely, I think if it's more sort of support type of staff that just sort of helps you keep growing, and it's not someone who's going to help you make decisions, I think you can definitely defer those for a few months. And just sort of see how things evolve.
Yeah, this is Justin again. And I would just add to that, just like the key is to just model it out, right? See what happens, see what it does to cash in your worst case scenario. And again, be planning for 6 to 12 months, maybe even longer, without additional capital coming in.
Great. Thank you. And if everyone is looking in the group chat, there's some fantastic links being placed about SVA and just navigating Amazon right now. So please, thank you. Well, first, thank you to everyone who's posting those, but also please look to those as additional guiding points. I'm seeing some SKU alumni as participants who are a little further along in their life cycle. I'm going to open this up to anyone jumping on to describe what they're doing in terms of just navigating this water. I see Cecilia from Kachina 54. I know that we've had a couple of back and forths recently about some you're doing, so I'd love just to hear your story.
Hello, can you hear me?
We can. Thank you so much for letting me put you on the spot.
No, for sure. I just I needed to make sure that I was away from the kids right now. So yes, so we have had, obviously being a frozen product, we have been seeing a lot of like sales growth in the last 2 weeks, and for sure, like online is now our challenge. So my main concern right now, like I heard that recommendation about like, look, if your competitors are out of stock, put an ad. So I think we are doing a shift for the first time to go online, which with a frozen product has it has its challenges. So if anyone has any recommendations about like frozen 3PLs or how to better this is more practical than like cash flow. We are a self-funded company, so we have always been operating on a cash positive type of business model. But my question is more tactical about like, how do you increase, how can we negotiate with FedEx, with UPS to have like better margins, better pricing with them, and what 3PLs are for frozen items? If anyone has any of that information, I know that this is an amazing panel, so thank you so much.
I hate to call out somebody else, but I do see Anthony Rena on the phone right now, and you have a lot of experience with frozen. Is there any advice you can give?
Yeah, thanks for the call out. You know, as far as what Cecilia is asking about, I think that, you know, there are people that have much more knowledge on that area as far as delivering directly through Amazon or some of the other areas. Most of everything that everybody said today makes perfect sense, especially, again, frozen products. We're seeing the same thing. I still am connected to Michelangelo's, and they're having a absolute, they've had to go to allotments for different companies like Costco, which is the first time I've ever heard of such a thing. So, you know, I think keeping calm, you know, everybody's going to get their share of this business, including the smaller companies. When you start to look at the larger groups, of course, they're going to be the go-to ones. As this shakes out down the road, as you guys know, I'm starting to launch, a little late in launching something that could have helped out here, but as we go forward, I've even had people reaching out looking for alternative co-packing opportunities. And that's kind of an interesting process as we're in the middle of this, which probably is going to be a little too late. But, you know, that's really, I haven't really heard anything that doesn't make sense. Obviously, cash is always king, so be very careful with your funding. You don't know how long this is going to last.
Thank you so much, Anthony. I really appreciate that. And I know you're doing some amazing things to support the infrastructure of the local CPG world, and let us know how we can support you as you continue to support us. So always great hearing from you.
Thanks.
Are there any other questions from companies? I mean, this is the forum of, you know, our SKU community really to be able to answer some tactical questions that you may be facing. Okay. Well, if that is the end of our questions, oh, sorry, there's one coming in from David. Anthony, can you expand on any of the alternative co-packing opportunities? This might be something that you can speak to. And then I know Trish is also on the line and might be able to weigh in on some additional resources from a production perspective.
So this is Anthony again. So yeah, the alternative is I've taken over the small co-packing facility over there off of Mueller, the old Sky Chef facility, but I'm not operational yet. Like I said, I kind of missed out a little bit here because it could have been a help to some of the companies and will down the road. You know, one of the reasons for doing this, and most of the people that know about it at this point, because I've reached out to most of us in the community that on the influence side, was to actually start looking at how I can best service the companies that are moving out of the Capital Kitchen area and into a smaller co-packing process. They're having just a hell of a time finding facilities. But the facility needed some updating, need some things that, and it just wasn't ready to start running just yet. So I'm kind of maybe 30 days, 45 days out from doing that. And of course, this has become a little bit of a hindrance in getting services in there, from electricians to working through some of the stuff that's actually not operational at this point.
Trish, do you want to jump in with any words of wisdom for individuals who are looking for commercial space? There was a question specifically about co-packers in the juice area. All right, maybe Trish isn't on the line anymore. So I have a few more questions coming in on supply chains. Outside of the food suppliers and the co-packers, do we see any trouble in the future for print companies, packers, getting, various parts of the bottling and packaging here, or are they going to keep on running business as usual? I just think there's some concerns right now with the suppliers and the items coming from China. Felipe or Justin, do you guys have any experience dealing with these issues from your clients?
This is Justin. Not specifically on items coming from China, but we do have concerns about. I think we're starting to see in the last couple of days here concerns about truck driver shortages. So regardless of whether specific producers or suppliers are still able to function, it looks like it's getting to be tight in terms of just being able to take delivery on anything. So that's another area of concern in the supply chain.
Same here. We haven't had any issues with packaging. A few of our companies that do import their packaging from China or wherever else, they have enough in stock for the next 6-7 months. So from that side, we seem to be okay. Haven't seen any issues there yet.
Can you hear me now, Kirsten?
We can, Trish. Thank you so much for jumping in.
Hi, thank you. So there are some facilities in Austin, as you know, Capital Kitchens and the Cook's Nook are definitely, it's looking like some, in the conversations I've had this week, it looks like some of the companies are, not ramping up any more production and are backing out, and then others are ramping up their production. So it just depends on the product. So I do know that Capital Kitchens is making space available as they experience their own shifts. So that is an option. It does mean usually people need to go in and make their product themselves. Again, kind of take it back in-house, and they'll need to go through the permitting process to do that first. But you can read, I think Shannon from Capital Kitchens might be on the line here as well, but you can reach out to them directly and inquire. It's probably worth inquiring with them for sure.
Great. Thank you so much, Trish, for jumping in. So I really want to be cognizant of everyone's time. I know we're all scrambling to, get our ships righted. And so I want to thank all of the speakers, everyone on the line, for jumping in and, putting our heads together to help companies and each other weather this storm. Next week, we are going to be doing another town hall, same time, same place, Zoom, at 11:30. And we are going to be covering a variety of topics. And this is going to really be talking about the operation side of it and the buyers and what we can expect there. So from logistics to FedEx and 3PLs, just to bring your questions. Or if you can't make the call, we will be putting a recording of the town hall online for everyone to access as well. So keep your questions coming to anyone on the SKU team. We'll direct you to the various resources that we have internally, and we hope everyone feels a little bit better, heard, and connected with this call. So again, thank you so much to everyone, and hope you guys found this helpful and beneficial, and keep doing the good work, and we'll be back next week.